Major central banks were expected to pause rate hikes soon, but now it's not so clear cut. The market has been pricing in interest rate cuts from major central banks towards the end of 2023. However, sticky core inflation, tight labor markets, and a surprisingly resilient global economy are leading some economists to reassess. Stronger than expected U.S. jobs figures and gross domestic product data have highlighted a key risk to the Federal Reserve potentially taking its foot off the monetary brake. Economic resilience and persistent labor market tightness could exert upward pressure on wages and inflation, which is in danger of becoming entrenched. As the Fed implemented its 10th increase in interest rates since March of 22, raising the Fed funds rates to a range of 5 to 5 and a quarter, Chairman Jerome Powell hinted that a pause in the hiking cycle is likely at the FOMC's June meeting. However, minutes from the last meeting showed that some members still see the need for additional rises, while others anticipate a slowdown in growth, and which would need to remove any further tightening. Fed officials included St. Louis Fed President James Bullard and Minneapolis Fed President Neil Kashkari have in recent weeks indicated that sticky core inflation may keep monetary policy tighter for longer, and more hikes could be coming down the pike later in the year. The European Central Bank faces a similar dilemma, having slowed the pace of its hiking increments from 50 basis points to 25 basis points at its May meeting. Headline inflation in the Eurozone rose in April to 7% year over year. Though core price growth posted a surprise slowdown, prompting further debate as the pace of rate rises in the ECB should be adopting as it looks to bring inflation back to earth. The Eurozone economy grew by 0.1% in the first quarter, which was below market expectations, said the Bundesbank president Joachim Nagel. He expects to see several more rate hikes will be needed, even if that tips the bloc's economy into a recession. Now, the UK faces a much tougher inflation challenge than the US and in the Eurozone. The UK consumer price inflation rate fell by less than expected in April. With inflation continuing to improve, stickier than the government and where the government central bank had hoped, traders increased their bets that interest rates will need to be hiked further in order to curtail price rises. Despite the expectation for rate rises further for longer from many economists, we still expect to see a full reversal of course before the end of the year. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. I appreciate your time and have a good day.